Hey, Dmitry, you about ready to go?
Yeah,
6 o'clock. Let's
definitely.
start the broadcast. Hold on.
Okay.
Hey, everybody. Thanks for joining us. This is Dmitry and Will, and we're going to be discussing the basics of options. We're also on YouTube Live. Anyone on YouTube Live, please put your questions in the chat. In Zoom, everyone on the webinar, please put it in the question and answers. Alex, I did see your, we were chatting early. Everyone was on there. A lot of people on YouTube right now. Just send me an email directly with your question to support. Just put in the headline, Will McBride. I'll grab it and try to help you. Everyone else, thanks for joining us. I'm going to launch a poll real quick, Dima.
Yep.
This is a little poll for everyone. This is options basics with Dmitry. So we're going over we're starting at the beginning, right? Right at the starting point of options.
I'm just going to talk about a call option and put option and really try to, explain how that works. Sometimes that's the hardest part, is just to really picture, a call option and a put option.
It's so interesting. The start. It was a long time ago that we got started. But the two questions in the poll on the Zoom meeting: how long have you been studying options as an investment tool? And it's 1 hour, 1 day, 1 month, or a year or more. The second question is, have you ever traded an option before? Yes or no? I'm launching that. Let us know, please, because it is helpful. And actually, if you heard it on YouTube, just put it in there. I'd like to put it in the chat. I'd like to hear it. Right now, we're at about 50% a year or more, D, 33% a month, 20% 1 day, and 60% have traded an option before.
Okay.
So that's the first 20 seconds. We'll leave that poll up for a while. Do we want to do a disclaimer real quick, D?
Yeah, let's do that before we start. Get that out of the way.
Let me bring that up. Hold on.
All right, and thanks everyone for joining us. This is like the first time where we're going to try to do the very basics and options. I think usually we start right in the intermediate level, where we assume you already know the basic call and put option. But here's the disclaimer, everyone. Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need the advice of a professional, then go seek either a registered investment advisor or call your broker for help. There's the disclaimer, everyone.
Excellent job with the disclaimer, as always, Dima.
Thanks, Will. I can start sharing my screen, unless you wanted just to.
Yeah, let's go. Let's go.
Okay. So let me see if that comes up. All right, everyone. So look, we're just going to talk about very basic, what is a call and a put option, and really sometimes that's actually the biggest hurdle to trading options. Like, what's going on here? Sometimes it's very hard to even imagine it in your mind. Like, what does this do? This is a risky vehicle. And the most important thing is to educate yourself, right? To really feel comfortable with what it is before you could actually use it as a useful tool. So I'm going to talk about a few concepts about call and put options that are important, such as like a strike price, time value and decay, early exercise. But even before that, let's just try to go over an example of a call and a put option. And sometimes I just step away from the stock market to give an example, and then I'm going to relate it to the stock market. And I'm going to tell you, this is a true story that happened to me. And this was after remember when we had that market crash in the real estate business in the real estate 2008? After that, a lot of these condos in Miami, they went down drastically in price. So we'll remember I flew out there. I'm like, hey, maybe we should start like scooping that up as like speculative bets.
Yep, totally remember.
Yeah, so I flew down to Miami, and I started going with a broker and looking for, things that I thought were already very inexpensive, and to buy it, hold it, wait for them to appreciate back up to like where they should be. And I ran into a situation where the guy wanted to sell a condo, and this condo was something like, I think it was like $350,000 at one point in Miami. it dropped to 200,000, right? So it went from 350,000 to 200,000. He was an investor. He wanted to sell it for 225,000, right? So it was like 25,000 above like where really the market was. And it was a rental unit. So let me just go over this example and bear with me because this will help you kind of understand the concept of an option, okay? Since he was trying to sell it for 225,000, well, what's the deal with that? You know, there are other units there for 200,000. He said, look, the broker called me up and he said, this is what he's willing to do. He's willing to give you, he'll rent it to you for a year with an option to buy, right? So I don't have to buy it today. He's going to give me a year to wait, then to decide if I really want to buy it at 225,000, which to me was kind of appealing because that's what, in my mind, I thought that's what it was going to take for the market at that time to recover. So we would have more clarity in a year. And if it didn't recover in a year, probably then the market would have just kept going lower because at that point we were getting injected stimulus into the economy. You know, they bailed out the banks at that point. So I thought maybe it took about it, look, in a year's time, things would settle up. So that was kind of appealing to me that I don't have to buy today. I have a year to wait. So I could buy today at 200,000, or I could wait a year and buy for 225, but that's my option, or just back out. And here's what he said, you know, you rent it for me for a year. At the end of the year, you could buy for 225,000 or not, you know, and you just walk away. The other thing that was happening is because he was an investor, he already had somebody renting the place. So I think it was like something like, you know, the risk was like $1,200 a month. I forget what it was, but he had a renter in there who said he'd renew. So I didn't really even have to wait a year. You know, as long as the renter guy said he would renew, as long as he was paying his rent, I would just hand it over. So I didn't really even have carrying costs at that point. He was already in there. So it's kind of like just a free chance to wait a year with an option to buy, right? Now, if it went down to 100,000, I would be really happy I didn't buy it for 200 and I could just walk away. So the other thing though, is he was giving me an option to buy it, but it wasn't free, right? He wanted something in return. So for that option to buy, it was a $5,000 fee. So I'd have to put $5,000 down towards the purchase. If I didn't buy it if I decided at the end of that year I don't want it, I lose that 5,000, right? So that was kind of the cost of my option. Okay, so does that make sense, Will? Like
that makes sense to me. Does that make sense to everyone? Put it in the Q&A or the chat on YouTube.
So this was the conditions, right? I get to rent it for a year. It was $1,200. He said, you know, for that clause, you pay him $5,000. Of course, you know, he would keep that $5,000 if I walked away. That's to show that I'm serious. Market was $200,000, but I have an option to buy for $225 above today's market, but I had the option to walk. So let's just take a look at this scenario really quickly and see like if I thought that in a year, right, that this condo had a chance, it was 350 at one point. If I thought in a year that there's a good chance this condo will be worth 300,000, right? 300,000 above, it's 200 today, 300,000 market value. And I paid $5,000 for it. You could see that would be a great deal because what just happened here? At $300,000, I have an option to buy for 225, right? So really I make 75 grand. That's the difference between the price I buy and the market value, 75 grand. Really I paid $5,000, so my profit would be 70,000. But you could see that my risk is $5,000. So I took $5,000. That's my risk. If I walk away, I lose that. But I made 70,000. So you could see the return is an incredible return, right? That's what we call leverage, right? I didn't put up, if I had to buy it for, if I had to buy that condo right off the bat, I'd have to put 20% down. I think at that time it was even more because the banks weren't lending. They're doing like short sales. So I had to put like 60 grand down probably. In this situation, I'm only risking $5,000. And in my mind, I thought it was a good chance that it could go to 300. And if not, I lose that 5 grand and the guy keeps his condo. So that's why we talk about options as leverage, because he gave me an option to buy. Now, for him, in his mind, why would he do something like that? Well, in his mind, right, he was like, I'm happy with the rent, and he doesn't think, in his mind, in a year, the market's going to increase above 225. He'll be super excited, and he won't, that it went up above 225. He'll be surprised, and he'd be very happy with it. But he's like, there's probably no chance. It'll probably be around 200, maybe 210. So why would he do that? Well, he still gets his rent. And in a year, not only does he get his rent, he gets an extra $5,000, right? So he made that extra $5,000. And if the market goes up, he's obviously selling it above what today's market is. So we both have a difference of opinion, right? And that's why we're entering in that transaction. But one thing that I had in this transaction, right, since I'm buying it for 5,000, I have that option. I could buy it or I could walk, right? So that was my right. I'm not obligated to do anything. I could walk, I'd lose that 5 grand. He has that obligation to sell me the place according to the clause. So if it goes to $1 million, he has to sell it to me for 225,000. That's the contract, right? He got 5 grand for it. He's obligated then to sell me that place if I exercise my option to buy it, right? And that's how options are constructed. One person has the right, has the option. The other person, he gets money, but he has an obligation now to deliver you that product. That's what we would call call option in the stock market. So here, let's just take a look at what is important here, right? This 225, that's important because that's what we would call a strike price in an option. That's where we would have to transact, right? He has to sell it to me at that price. I have the right to buy it at that price. That's what we call a strike price in a call option in the stock. So that's important. This $5,000 is important. So why is that $5,000 important? Because that's how much I'm paying, right? I'm buying a clause and I'm paying $5,000. Now this $5,000 actually that I'm paying today might have a different market value tomorrow. It might have a different market value actually in a month from now. Because let's say I'm kind of correct, right? Let's say I'm correct in the stock and the market reverses in Miami and this building is hot. And even though I have an option, and let's say I have an option to buy it within the next year, right? But let's just say the market increases from 200,000, let's say goes to 250,000, right? Let's say today, that's the market value, 250,000. Well, that's already $25,000 above my strike price, right? I have the right to buy it for 225. If today somebody's willing to buy this condo for 250, this is what we call the condo now. It's that option, my option is in the money. What does that mean in the money? It means that I could already, if I exercise my option, I could buy below today's current market price, right? So how much is it in the money buy? Well, if the market price is 250 and I could buy it for 225, $25,000, it's already in the money, right? So this $5,000 already is really worth more than 5,000, right? Because you would do that all day. If somebody said, well, I'll sell you my option for 5 grand, well, the total cost will be, and I buy for 225, the total cost is 230 grand. But if I could flip it for 250, well, I would make an instant $20,000 profit. I couldn't make an arbitrage. So really my option, even though I paid $5,000, if the market is 250, well, that option has to be worth at least 25,000 because that's the intrinsic value, or I could just exercise it in arbit. So that's our intrinsic value. It's worth at least that because I could just sell, but buy it, exercise it, buy it, and flip it back out, right? So whatever it was if it was $5,000, let's say it's worth at least $25,000 today or a month from now. Well, what happened was, it went up in value. We made, 20 grand on that option. And in the market, right? When you have a market, in that market, you would be able to sell that option out, right? So maybe you don't want to buy the house, but you're saying, I achieved my objective. All I wanted to do was profit from my option. And you could sell that option to somebody else. They might want to buy that house and they're willing to take your option. Or another person wants to wait it out till the end. So in a free market, like we do in a stock market, an options market, you would be able to buy and sell these. Okay. So hopefully everybody understands what I mean by like intrinsic value. Well,
we can ask them, right? Hey, everybody, what do you think? Do you understand Dimitri's example of intrinsic value and what it means in the marketplace? Just send me a yes or a no in chat, and we'll get a good idea of what the crowd is thinking. We do have a lot of users tonight, D, who are on the show, so we should get a good response.
Oh, thank you.
Mostly yeses coming in. Hey, everyone on YouTube, please give us a thumbs up. It is very helpful to our channel. And also subscribe because you'll get alerted to anytime D does a new video or when we put on a webinar like this, or we do have a morning show in the AM right around 9 every morning, which is always filled with some interesting chat on YouTube Live. And Dmitry always gives a great walkthrough of what's going on the Chameleon that day. So everyone is a yes or a yup or a yes, sir, awesome, or a why. So there's a lot of yeses out there, Dima.
Awesome. Awesome. Thank you, everyone. So since we know the intrinsic value, let's take another component that in an option, it's not just the intrinsic value, but what we call is a time decay or time value in that option, right? So what did the guy want to do? Like this investor, why was he selling me this clause for $5,000? Well, right now, really what he didn't think that the market was going to recover. There's no way. He's like, that I would buy for 225. That was his outlook. But he's looking, saying, look, I'm getting $1,200 a month right now in rent, right? $1,200. So I'm yielding, take 1,200 times 12 and whatever he bought the condo for. But let's just say like 200,000. It's like, so whatever he was making for it, that's the yield, right? He's like, how do I increase my returns? Because what he was interested in is just to make more money off the rent, and $1,200 was only covering, at that time, it was only covering like his maintenance and taxes. Because I think the maintenance was high taxes. So he wasn't really even, he was like breaking it. So he was trying to enhance his yield. So what does that do? Well, if you take $5,000, it's approximately an extra $400 a month if you split it up over 12 months. So he's adding to $1,200 an extra $400, right? So that's what he was looking for, to get more yield out of his investment, because he didn't think that this scenario would play out. It was like, that was in his opinion, right? Of course, if I buy it, I'm on the opposite opinion. That's why two sides meet. So this is why he was doing it, to enhance that return on his investment, right? Everybody see that? Again, $1,200, you add another $400, $1,600. Now, of course, that $5,000 that I'm willing to pay today, because let's say I'm willing to hold it for a year, I think that's enough time for the market to recover, right? So that, to me, at that time it was a reasonable time. I was like, yes, there's a stimulus. I see the short sales. They're like just getting rid of all these. These are 200,000. These are short sales. Once it cleans up, it's going to go back up. But I think it'll take a year. But what happens, let's say, what happens, you do the contract, you have 12 months. What do you think if nothing happens, if the stock, and let's say a month goes by. So a month goes by, now I have 11 months left on my clause, right? Well, that's less time now for the market to recover. And let's say after month one, nothing changed. The situation is exactly the same. The condos that are for sale for 200,000 are sitting there. Nobody's buying them. The market is the same. It's not getting any closer to my 225 strike. You know, what do you think that clause should be worth the same $5,000? Should it be worth more, or should it be worth less? Like, what do people think? Anybody guess?
Any guesses there out there?
Huh?
Any
So,
guesses?
yeah.
Someone says less, someone says less, someone says less. Any guesses?
There you go. Right. It should be worth less, right? Because all of a sudden it's less valuable because I don't have as much time for that market to recover. Before I could wait 12 months, now I have to wait 11 months. What if another 3 months go by? We're in month 4. What if we're in month 4? I have 8 months left and the market is still 200,000, you know, it's not moving and it's not getting any closer to my 225. Well, now it's going to be worth even less than that, right? Less than 11 months because now I only have 8 months to go. So what is that called? We call it in options time decay, right? So as time goes on and I'm getting closer and closer and closer to the expiration or to the due date of my contract, it loses more and more time value, right? Because I have less and less time for my outcome to become more favorable to me. And now it's worth less and less. So that's time decay. So even though I bought that contract, every day goes by and it doesn't get closer to or more favorable to me, I lose that time decay. Okay. Does everybody understand like that time decay?
We'll put it out there. Does everyone understand time decay, or does Dmitry need to go into it further? Just put it into the chat. A lot of yeses coming up on the.
Awesome. So that's kind of an example. So let's look at what we went over. We went over an option, right? One person has an obligation. One person one person has the option or a right. The other person has an obligation. We went over intrinsic value, right? We went over time decay. So these are very important concepts that you have to understand if you're getting into an option, right? You really have to at least start understanding that before you even start looking at an option. That's what in a stock, that's what we call a call option. The option, you have the right to buy, right? The right to buy. Now, also, there are two types of options. One is, and most of them are American exercise options, and some are European, right? So what is an American option? That means I get the right to exercise my right anytime between now and expiration. So if today the house goes, this condo goes to 250,000, if it's American exercise, I don't have to wait till the end of the term. I could just say, you know what, I want to exercise my option. Here's your 225 grand. I want the condo, and I get to do whatever I want with it. I could live in it, continue renting it, but it's mine. I'm not going to even wait till the end. European is not the same thing. European is you could only exercise at the end of the expiration, which is in a year, right? So you would not be able to, just take that asset anywhere in between. And like maybe in this case, let's say you had a buyer for 250 grand, you could just exercise it and flip it, right? And you're out completely. European, it's a little bit different, which most are American exercises, but when you're dealing with like indexes, those become European, and some are even cash settled. But that's the difference between American exercise and European, and the price of them will also be different. So can anybody guess what is more valuable, the American or the European? Like, would you rather have the option to buy it at any moment or on any day between now and expiration, or if you do it today, you have to wait till the end?
And they're coming through. We've got American,
Right.
one American, two Americans.
Perfect. Right. Because that right gives you actually more flexibility, right? Instead of being able just to exercise it at one time in the future, you could exercise it at any time in the future. So that gives you actually more value and more flexibility, because there might be a situation where it's better to do it right now than wait till the end, right? And and that makes an option a little bit more valuable. So there's a little bit more premium in that option when it's American exercise. So again, let me see if I could just recap. Okay, so this is just, so again, I'm just going to recap, American exercise, more valuable, gives you the right to exercise that option at any moment. Of course, you'd have to pay a bigger premium to that seller. We went over an option strike price, right? That's where you have the right to buy. He has the obligation to sell. We went over the premium. It's broken down into intrinsic value and time value, right? Time value is what you're paying extra to hold that contract.
D, I'm just confirming you want to be on the same slide, option to buy a condo. Is that correct?
Yeah. I went to the next slide, and I think I already covered that part of it.
That's fine.
And this is how we would look at a call option. So let me actually just go to let me exit this part. Let's go to an options chain here. So here's Apple, right? So this is Apple, and I brought up an Apple options chain. And these are now don't get intimidated yet, because think of it this way. When we're doing a condo, I just showed you an example of one option. But in reality, when we're looking at stocks, they have lots of different options, right? So with the terms a little bit, they're changing a little bit different. So what do we have here? I'm going to go to the expiration. So these expirations, August 14th, August 21st, August 28th. These are when this option expires, right? So I showed you an option with exactly 1 year. This one, August 28th, has 14 trading days. August 21st has less, 9 trading days. August 14th, this has 4 trading days.
Does everyone see how he's doing that, where he's seeing the trading days? Everyone aware of that? Understand what he's saying? Because working through this, understand this options chain is a very good place to start and look, it's where you're seeing all the prices in the marketplace.
Exactly. This is where you're going to go and actually look at, well, how much will this option cost me? Or how much can I buy for? How much can I sell it for? What prices are other people trading the option? And eventually, as you get better and better, you're going to actually be able to do a statistical analysis on it, see if this option is it worth it for me to do it or not worth it. So on this side,
we are in the basics. So someone lands on Market Chameleon they're asking how you even get to the options chain. So can you just
So up here we have like a simple search. So first you want to put in the stock that you're looking up, right? So think of it as like if you're on Zillow and you're looking up Miami condo or Fort Lauderdale condo or whatever, but you put out a symbol here. So I just put in Apple. That's the symbol for Apple computer, right? You could just do search. You land, well, I was already on there, but here let's do Facebook. So I'm going to do Facebook over here on this side, right? There's more menus here. You're probably, going to land on the summary, but go down to options over here and hit options chain. Everybody see how I did that? Let's go to options and hit on the options chain.
All right. Everyone's
That brings it
got
up.
that. Great.
This is the options chain where you're gonna go to, because you're gonna have to look up what are the prices for the different options, you know, what are other people trading them for, and eventually you're gonna be able to, when you get better, have some analytical skills to make a better determination, you know, is this option a good price or a bad price? Or, you know, or if you have a good outlook, you'll be able to determine that as well. So in this options chain, this is how it's organized. Down here, what we have is you could pick the different expirations, and that's equivalent to what I was telling you. He gave me an option to buy it in a year, right? But options on stocks have different expirations. It doesn't necessarily have to be a year. They're always listing different expirations. So you'll have short-term, intermediate, and long-dated options. So over here, August 14th, this only has 4 days to go. You know, tomorrow only have 3 days to go. 2 days eventually will expire. Now, out here, as you can see, everything in between. If I go to like September of 2022, this has 531 trading days to go. These are the more long dated options. So these, right, these give you much longer periods, like say in Facebook, stock is 262. These here are the calls. So the calls are kind of equivalent to what we went over. The calls are on this side, the puts are on this side. So let's just stick with the calls now. So here's today's price in Facebook, 262.98. That's equivalent to what I showed you where I went and I saw that condo, the market was 200,000. So that's the today's market price where you could transact. So you could see here, well, what if I don't want to buy it for $262 today because I think it's going to go up, but there's also probability I'm wrong and it's just going to go way down. So let's say I think it's going to be above $300 in 531 trading days or sooner. So this is the price. This is the bid and the offer for that option. So what is the bid and the offer here? The bid, that's where in the marketplace, that's where you could go and sell that option. So if you own that option and you want to sell it out, this is the best displayed price. Okay, let's call it a displayed price. This is where somebody has already put out the bid and you could sell it to them immediately. Okay, that's 41.85 that I'm putting out. 45.25, that's the displayed offer. That's the best offer where if you went directly into the market, you bought it, you know, you buy it, it'll cost you $45.25. So you could see here, if you bought it and tried to immediately sell it, this is what we call a spread. You would lose money because if you bought it for $45.25 and just turned around the next second and sold it back out for $41.85, you lose money, right? Because you bought it for more and you sold it for less. And this is what we call the bid-ask spread. That's where the market makers, that's how they make money from different people trying to buy it and sell it. And they think the fair value is somewhere in between that. So one thing to keep in mind is you could always try to negotiate. You could put limit orders and go in between. And you try to, the closer you get in between, the midpoint, the better. The further you pay above the midpoint or sell below the midpoint, that's like your fee. So that's an important concept to remember, that these fees add up when you're trading. Always try to figure out what the midpoint of the market is. And you could try to get in between the market, because think of it this way: if you could buy it, this option for $43, let's say, instead of $45.25, you know, you're saving $2.25, right? Which is like 4%, 5% on your whatever that is. So it's significant. It adds up in percentage terms. It could be significant. Keep an eye out, bid-ask spread. Again, right? These here are different strikes. So when I was showing you, I showed you only one strike. 1 year to go, he wanted 225, right? That was really my only option with him. That's all he was willing to do. But with stocks in options, we see that we have other choices. We have 295, 300, 305, 310. So you could see a lot of different strikes, right? And what do we see here? Another thing to keep in mind is like, if you're willing to do a strike, like say at 300, you're paying 45.25. As you're going up in strike, the distance that it has to travel is more, right? So let's say I'm going up in strikes and we're going from, at 262 to reach 300, that's 14.1%. To reach 320, that's 21.7%. So it's even harder. It has to climb more. 340 has to go up 29.3%. It has to climb even more. So what do we see? That the more it has to climb, the less valuable it is, right? Because it has to keep appreciating more and more, which is harder, right? So as we're going up, the options are becoming less and less valuable. That's why we're see these prices. They're going lower and lower and lower as we're climbing higher and higher and higher in price, right? Hope everybody sees that. These are the bids and offers.
Hey, D, just an interesting point someone's asking. They're asking about the Theo. They'd like to see, like, when you're looking at the bid ask, they'd like to know exactly what the midpoint is. Right now in the middle is the Theo, which is based on
if you click on this, right, I'm just going to click on it just to make it easier, and I'm going to load the strategy. It calculates the midpoint for you. So, so here it's 43.55. So that's the bid, that's the offer, midpoint 43.55. That's kind of considered the market fair value, right? The midpoint.
There you go, guys. Right there.
Yeah. So that's how you just get the midpoint. Just click on it, open it, and this draws you a chart of what your payout would look like. So here, let me come back over here. So you see at expiration, what's happening is I clicked on, let me see, the 300, right? 300 call. The stock right now is 262.98. So obviously if the stock stays below 300, it didn't go up enough, right? So I'm not going to exercise my right to buy the stock at $300 if I could just go in the market and buy it for cheaper. If I could buy it for $290, I'm better not exercising my call because I could buy it for $10 cheaper at $290. $295, I'm not going to exercise my call. $299, I'm not going to exercise my call because why would I buy it for $300 if I could buy it for $299? I save $1. So really, you're never going to, if it's out of, and we call that out of the money, right? We talked about in the money. Out of the money means the market is away from that strike. Then this would be worthless. So let's look at that chart. So over here, we see if this is 262, this line here. If the stock closes at 262 or anywhere below, we would lose this $45.25. We lost it, right? The market didn't go up. We were wrong. And we don't want that option anymore. The option at expiration will be worthless because the time went by. So you see there, we lost all that premium. And really, we lost all that premium anywhere below 300 because like we talked about, even if it's 299, even if it goes up, but at expiration, if it's 296, 299, we're not going to exercise it and buy it and pay somebody $300 if we could go and buy cheaper. Basically, then this whole premium, it's gone. Just like we were talking about the $5,000. If the market is on that house $224,000, well, I don't need to buy for $225, right? So I'm just we lost that $5,000 in our example. Here we lose the $435. When it starts going above 300, remember now it's getting intrinsic. Now it actually has some intrinsic value, meaning that if I buy it, I have the option to buy it for 300. But if it's 301, 302, 303, the higher it goes up, the more intrinsic value it has. That's what this graph is showing.
Hey, D, while you're there, someone is asking, how did you get to the payout diagram again? Basically, you just click on the bid you click on what you want to do, right? If you're looking to buy the option, you'd click on the offer, and the payout diagram comes down below it.
Yeah. So in this situation where I'm going from the buy side, so I'm assuming, okay, if I click on the offer, this machine assumes, okay, you're coming in from the buy side, right? So I clicked on this 45.25 and said, well, what if I bought it 45.25? So this is what see, and you could change this to sell, you could change it to expiration, but it's going to assume, okay, this is what you wanted to do: buy, sub 22 call, 300 strike for 45.25. So then I hit load strategy to say, show me what that payout diagram looks like at expiration. So this will actually show you at what price you break even, like right there. So you're going to break even. Can anybody guess what is your break even if you have an option? If you pay for 300, you get the right to buy it for 300, but you paid 45.25 for it. So what's your break even? Anybody guess?
Anyone? 345 is a guess.
345, right? 345.25, right? Because you have to cover your costs, right? You got to cover your costs. Very good. Like, just like when I paid, remember when we were doing the real estate example, I had the right to buy for 225 the house, but I paid $5,000. So my break even is really above 230, right? Because I already paid $5,000 to him. So that goes into his pocket. That comes out of my bank account. So to cover that price of the house would have to go above 230 to cover my $5,000 option that I paid. So 45.25. That's what this is showing you at 45.25. Then after it goes above 45.25, then you're kind of making money one for one with the stock. So the higher it goes, the more money you will be making on that call, right? Now, the person who sold it would have the flip side of that. It would look in reverse. Actually, if you want, I could show you how that would look.
Definitely.
Let's say you sold it on the 341.85. So we sold it, right? We own the stock, we sold it. Let's take a look at that strategy. So you see how that looks in reverse. If the stock goes lower, if all you did was sell that call, if the stock goes lower or stays the same at expiration, you just kept the entire premium, $41.85. As long as it stays below the strike, you keep that entire $41.85. Once it starts going above 300, you start losing that intrinsic value, right? Because he's going to exercise it. So you have to sell it to him at $300. But if the stock is 310, you're losing that $10, right? Assuming if you don't own the stock, you'd have to go buy it at 310, sell it to him at 300. So that's how it starts to look from the sell side until it goes above the price of the strike plus whatever you collected, right? So my break even if I sold this at 41.85 would be 300 plus 41.85, so $341.85. If I'm selling it, that's my break even, right? Above that, I would start losing money. Does that make sense? Hopefully to everybody.
Let us know, everyone. Does that make sense? We have so many people on. We'll get answers real quick.
Okay.
A lot of yeses. Yes,
awesome.
Flooding through.
Okay. So
while you're on that, I don't want to jump too far ahead, but someone did ask, what is the theo? I know we don't want to give too much information tonight.
So
get them confused.
Let me do now. Theo is it's kind of a more advanced concept, and it's statistically you're trying to figure out, well, what do I think this option is worth? Okay, so there are different ways to calculate. There's no one way because you have to start making some assumptions based on this. I think it's worth this based on that. So it's you're introducing a model. It's a little bit more advanced, but let me try to simplify, right? But because I would want to at least in some ways satisfy that question. So let's take a look here. I'm going to bring this up, right? So here's an option, and let's just think about this. Just use like some simple math, right? Simple math, and let's just say I'm looking at this scenario and I'm going, okay, Today, the price of this condo is 200,000. But I think the reason for this condo is 200,000 because you have like 3 short sales. Once they're gone, then all the rest of the offers are much higher. Okay. And here's what I have to do, figure out is what is the theoretical value of this option? Is 5,000 a good deal? Because maybe it's too cheap, maybe it's too low. I might be wrong, but is it a good deal in my mind? So let's do this. Let's just say, I think, and I did this let's just say I did this deep analysis, whatever, and I think there's a 10% chance, okay, 10% chance that this condo in 1 year will be worth $325,000, right? 325,000. So how much is that above to where I have to buy it? If I buy it at 225 and it's worth $325,000 in a year, how much would my profit be? Anybody?
Any guesses, everybody?
I buy it for 225, sell it for 325. Buy it for 225,000, sell it for 325,000.
The number of coming back seems to be 100 grand.
100 grand, very good. So this is where I think there's a 10% chance that is going to be where the condo is in 1 year. Okay, I'm only giving it a 10% chance, and let's just say whatever I think, like based on the number of sales, these and the number of inventory, it's going to take a year to eat through them to go up to basically back up to the same price of 325. So let's say, but I think that there's a 10% chance it's going to go to 325. And let's just make it simple. I'm not going to say anything else in between. And let's just say 90% chance, I think there's a 90% chance that it's just not going to move from 200. Like, because if these 90% chance that if these short sales do not go away at 200, it's not going anywhere, right? And there's like maybe 5 of them, right? But if all 5 of them go, then it's going to go to 320. So 90% chance that I'm going to lose on this scenario. So let's do the math, right? What do you guys think it's worth? If 90% chance it's worth 0, and there's a 10% chance it's worth 100,000 at the end of the year, what do you think this option should be worth? Anybody guess? What is the theoretical value?
In everybody, put your guesses in.
This is a theoretical value. This is kind of the concept of a theoretical value.
Guesses are coming in slowly. We have one for 50K.
Okay.
One's 10%. I don't know.
Okay.
Any other guesses out there, people? For whoever guesses it right, I'll send a Market Chameleon t-shirt.
All right.
10,000.
Okay. All right. So very good. So that's it, right? It's $10,000 is your theoretical value, right? Your theoretical value is $10,000. Well, why?
Nice
10%
job,
of the
Christine.
time. Huh?
That was Christine who guessed that on
Awesome.
Zoom.
Well, thank you, Christine, for that answer. So, and it's tough because you have to get used to statistics and what. So what is a theory? Why in theory is it worth $10,000, right? Well, if I could find similar situations, think about it this way: very similar situations that 90% chance I'm going to lose it's worthless. It's 0, and 10% of the time it's going to be worth 100 grand, right? And I could do this bet many times over, right? Let's say 10 times. Let's say I found exactly this scenario and I did the bet 10 times, right? So if I did the bet 10 times, 9 out of 10, it's worth 0. The 10th time it's worth 100,000. So if I take 100,000, split it between 10 bets, each bet to me is worth 10 grand. That's my break even, right? Because I'll bet 10,000, lose 10,000, lose 10,000, I'll lose 9 times, 10th time, I make back 100 grand. That's my break even. Theoretical value is kind of like what you think your break even is based on the odds of this happening. Does that make sense? Hopefully to everybody, how a
Yeah.
theoretical value, and that's how you build as a trader. You start building models of, well, if I'm going to do this trade, what do I think it's worth, and how much am I paying over or under? You know, and it's obviously these, in theory, you're going to be making some assumptions. You're going to be making some you're going to presume some odds, but you're going to use common sense or maybe, you know, historical outcomes to help you come up with those odds, right? So something reasonable to come with. It's not exact, remember, because there's no way to know exactly. There's no way for me to know exactly, like, you know, this will be 325. These are approximations, but I would have to approximate somehow using common sense and what I think it potentially could be worth, right? So let's just say, really, I think that this condo could be worth 325 because that's the cost of replacement, right? Right now, they're very low. You can't build them for 200. You can't build them for 225. It costs at least 325. And I think there's a 10% chance it's going to go right back to so you'd have to use common sense, and these theos are based off assumptions. Remember, it's assumptions which you create models from. Was that helpful? Did that make sense?
Does that make sense to everyone? Yep, we're getting a lot of yeses back.
Awesome.
A lot of yeses.
All right.
Just so
Thank
you're
you.
aware of the time, D, it is now almost 7 o'clock.
All right, so let's stop there because I think that we talked about a lot, and actually even throwing the puts in there right now, let it sink in. Like, hopefully this was really helpful to people. And again, we're trying something different where we're going like from the very beginning. Never actually, I don't even know if I ever did like an explanation of a call or put before, except maybe to my son. And he wants me to teach him what a put is right now.
That's awesome.
And yeah, and he's 12 years old. I'm going to teach him what a put is. I'll see if he takes it, but if so, you know, we'll see how you know, we do with the put next time.
Well, so next time we'll start with the put, and that will be next Monday's show. We'll just go with the put. And I mean, we had questions about the Greeks. I thought we did a webinar on the Greeks. Check the MarketChameleon.com YouTube channel. We have hundreds of videos there now, and Dima's put out a lot of great videos about how to use Market Chameleon. I thought he did a whole webinar on the Greeks, but
I think we did do it on the Greeks. You could probably find it. We have a lot of videos out there, but maybe as we go further into it, you know, I'll start hitting the Greeks.
Yeah, well, we're trying now a series of webinars for people who are just getting started in options and trying to help them out and guide them into how. And for those who don't know, Dmitry and I were partners, and we actually traded on the floor of a few of the major exchanges, the American Stock Exchange, the Philadelphia Stock Exchange, the CBOE, and we were the market makers for how many years, D? It's a lot of years.
Like, huh? Yeah.
A lot of years.
15 years, I remember. Yeah, a lot. Yeah.
And
So,
now we take the tools we used and developed Market Chameleon. So that was the start. So now we're trying to help other people out who are just getting their feet wet. So it's good stuff, Dima.
All right. Thank you, Will. Thank you, everyone, for joining us. And hopefully we have a morning show tomorrow. Hopefully you guys join us on the
morning show. We really go over how we're looking at the Chameleon in the morning. So give it a try. Register for our YouTube channel, because that alerts you right when we go live in the morning and when all our videos come out. So that's a big thing to do. All right, everyone. Thanks for joining us. You have a great evening and a good start to the trading day tomorrow. Bye, D.
Thanks, everyone.